Hi, what I would like to do today is to review the current trend in the business cycles and also how some sectors are reacting to it and see if we can learn something about what's going on and what are the risks in the marketplace. The reason I emphasize the business cycle in the study of its main trends is because understanding its behavior helps to manage risk. And that means that investor can use the trends of the business cycles to select stock sectors rising faster than the market and declining less than the market. This approach reduces the risk of large losses and makes returns more reliable. What I would like to do in the next few slides is to give you an example of what I mean. It is important to recognize that the business cycle drives earnings. In other words, earnings rise only if the economy strengthens, and earnings decline if the economy slows down or there is a recession. Of course, earnings drive stocks and the stock sector performance. Now, an important concept is momentum. The reason momentum in stocks and stock sectors, of course, works is because business cycle trends change very slowly, as I will show you in the next slide. This is the most recent information available about the global business cycle from the OECD. And what it shows that from 14 to 16, the global economy slowed down. Then it strengthened from 16 to 17 to early 18, and then from early 2018 has been slowing down. This is important because it relates very closely to the US business cycle. This is the business cycle as is available in every issue of the Peter Deck portfolio. And as you can see, like the global business cycle, it shows that the economy slowed down in 2014-15, it strengthened in 2016-18, and instead is slowing down in 2018 and currently still in the process of slowing down. Now, I was talking about before about momentum. The reason momentum works is because you see periods of slowdown or strength last for 2 years at least. So this is why the economy is slow moving, and that's why momentum works. Now here on the top panel, I show the financial, the ETF XLF, and how it performs relative to the market. And as you can see, financial stocks are weak relative to the market, that is, go down or go up much slower than the market when the economy is slowing down. So when the economy is slowing down, this is not a good sector to invest in. On the other hand, as you can see here, financial stocks are stronger than the market when the economy strengthens. When the economy slows down, as it happened from 2018, the financial stocks have been weaker than the market. So there is no surprise why the financial stocks are not performing, because the economy has been slowing down. And as you can see, the trend is now for more than a year that is in place. This graph shows how the transportation stocks, as measured by the ETF IYT, behave during a US business cycle. Again, this is the economy slowing down, this is strengthening, and this is slowing down again. As you can see, transportation stocks are much weaker than the market when the economy slows down. They strengthen somewhat when the economy strengthens, and then now since 2018 they've been underperforming because the economy is weak. So this, like the financials, the transport are cyclical sectors. In other words, they follow very closely the trends of the US business cycles. But not all the sectors are like the transportations and the financials. For instance, these are the discretionary stocks, XLY, and now they act relative to the market. Again, this is a period of slowdown, The economy strengthened from 2016-17 and slowed down since early 2018. Now, if you can see the discretionary, they behave instead, they are stronger than the market when the economy weakens. They are weaker than the market when the economy strengthens, and they are stronger than the market when the economy weakens. In other words, these sectors are counter-cyclical. In other words, when the economy slows down, they are strong. When the economy is strong, investors invest in other sectors, not in the discretionary, and therefore the discretionary weakens relative to the market. Since 2018, the economy has been slowing down, and sure enough, the discretionary have been stronger because they are defensive kind of sector. Another counter-cyclical sector is the dividend aristocrats, as they represented by the ETF NOBL. They are the stocks in this ETFs. They've been paying dividends at least for the last 25 years, so they are very well-established companies. So they, by definition, almost they represent a very safe investment, which means that when the economy slows down, they are stronger than the market because investors are looking for safety. When the economy strengthens, investors are looking for growth. Therefore, this sector underperforms the market. But since 2018, the economy has been slowing down, and investors again have been favoring stocks of well-established companies paying dividends for at least 25 years. So what is the point of this presentation? Is that the trends of the business cycle drive relative performance of market sectors. You just cannot buy blindly any sectors. There are some sectors that perform well when the economy is strong, and there are other sectors that perform much better when the economy is weak. An example of sectors doing well when the economy strengthens are, for instance, financials and transportation. Example of sectors doing well when the economy weakens are real estate, IWIR, and Noble. This information is reviewed in every issue of the Peter Dack portfolio, and of course has been examined in detail in my 3 books, Profiting in Bull or Bear Markets, Easy Ways to Beat the Market with ETFs, and Investing Wisely. It is easier than you think.